we're going to go to the market history. Market history is your back testing engine to see how the trend tracker, trend state signals have performed on every futures market, um, the underlying stock listing of every single stock futures. Um, and you can multi-select or single select. So if we single select, I want to look at something interesting. So one of the big things that's happened in the last couple of years, right? Let's look at silver. Silver was a huge move, and it was quickly reverted. So it will take a while. It's a bit of data. What's really interesting is the speed at which moves are happening now in futures markets, but also in stocks, right? It's just so obscene. How do you capture it, right? So the best way to look at if something is worth getting into is with expectancy, the mathematical expectancy formula. If you're familiar with Kelly criterion, might be also familiar with the expectancy formula. You have your probability of win, your probability of loss, your average win, your average loss. That's going to churn out your expectancy. You can also see that in a dollar value based on what type of futures contract you're looking at. Are you looking at a full? Are you looking at a mini? Are you looking at a micro silver? How many contracts? And when a market enters an uptrend caution or a downtrend caution state, do you want to reduce the number of contracts? So let's say we're at 20 contracts of micro silver. If you reduce by half, you're going to see the gains or losses on the uptrend and the downtrend caution states, uptrend caution, downtrend caution states, get reduced by half. If you go by full, you're going to see zero because you're not participating. The average win, all that stuff, you're basically saying, I'm going to sit it out. I'm only going to be in the market when it's in an uptrend or downtrend, and stay out of the caution states where there's chop. Now, that might cost you in some cases. That's not going to be the best solution, right? So that's why you do want to look at your expectancy and see where you have a positive expectancy. That means participation was a good thing, and negative means participation was a bad thing. If we go back to look at just the last year, you see the big move up happened between November and February, right? So you can see here most of this happened in uptrend. Some of it, a small amount, did happen in uptrend caution, and downtrend was just a takeaway. I mean, it was a net negative. So uptrend caution, if you had avoided that, say, okay, what if I was really, it was such a volatile, violent move, I wanted to get out of it quickly. I realize it's still in an uptrend, but it's moved to caution. I want to stay out. Okay, well, how much did that cost me to get out of that? So if we had 20 contracts of the micro silver, it wasn't available at the time, but we can hypothetically look at that. If we're in 20 contracts, it's nominal, right? So if you had been out of that, your bottom line would not have been affected. But maybe you didn't want to short it all, right? Typical trend following is long short bias, right? You are going to go both directions. A lot of people just want to go long. So if you want to filter out the hit from the downtrend, there you go, right? So that's what your total return would have been. So you can evaluate each market here as far back as you want and see where the damage was going to come from, right? Where were you going to get hit? What was going to cost you to stay in for overstay your welcome, essentially by staying in uptrend or downtrend markets. But at the same stroke, if we're going to look at something really standard, S&P, okay, we're just going to, here, we're clear as how we're doing just S&P. You're going to see something interesting. Okay, we're going to go, let's just say we were in 2 contracts of ES. Here, being out of the caution, the uptrend caution would have been pretty detrimental. Let's say we're only long, right? Being out of the uptrend caution in the last year, that would have saved you money. On the longer term time horizons, the longer you go back, the more profitable the uptrend caution is. So if you're really a long-term thinker, you might only really pay attention to when the signals flip from uptrend to downtrend and not want to fiddle with your exposure. If you did want to say, you know what, I'd like to take a bit of caution and just, let's say we're in a massive amount of minis here, okay, micros. You're going to see, looking back at let's look back through all time that we have history through 1984. You see that the majority of the gains were in the uptrend caution state. So even if you got nervous and you wanted to reduce, you could reduce by a third and you still would have yielded some result. Obviously, it's going to hit you. You know, the more you're out of that, the less participation you were getting. So there is merit to staying in during uptrend caution or downtrend caution if that market has a positive expectancy during a short. I'm not saying it's a necessary thing to get out. It's a comfort and risk level. This is just providing you what happened during those 4 trend states. Where was the, majority of the gain? So that's really what this market history search is good for. Of course, you can do multiple. When you do multiple markets, you are not going to be able to get a chart. It would be too convoluted and messy. It would provide no value. You're not going to be looking at contracts too. You're going to get expectancy, okay? And you can reduce that expectancy, and it's just going to pull it by the fraction that you reduce it. You can choose your long short bias, okay? It's all there, but you're not going to see individual contract or charting available because it just doesn't make sense. The other thing I want to show you about market history search, we are going to navigate away. We're going to go back to live tracker. But if we want to go to all market and any of these tiles, in fact, you can click on a market history and it'll jump you right to it. Okay. And you can also do this from the alerts page. If you're in the alerts, you have, let's say here, we have a test, which is all the equity markets. If I click pull combined history, it's going to jump me right to the market history search. It's going to pull them all up. So that's everything in the 9 things that we had in that watch list. It's the combined thing. This is looking at all stock indexes, right? So over the last year, you see uptrend caution still had the highest expectancy over the uptrend. Over the 3-year period, again, uptrend caution beats uptrend in terms of total positive expectancy. And again, as you go farther back, that remains true. You can also change your long short bias, see the damage that would have occurred trying to short markets. Because here's the thing about trend following and commodity trading or global macro or whatever the 20 names of this thing has. There's a misnomer that these funds make huge money during crisis years, right? Okay, so like what we have the 2008, 2009 crash, right? Recovery starts in 2009. Okay, yes, there's a year where downtrend made money and it had a very good expectancy, right? And a good average win, far outpacing the average loss. You can see that was a net positive. But crashes are typically frenetic, short-lived, right? A couple years out, that's thinning out. Now you look through, a decade, and suddenly running the exact same strategy is cutting into your profits. So maybe the best thing to do, sit out the shorts, right? That would have gotten you out of trouble in time, because during the crash year, you would have gotten out and just sat neutral to the stock indexes when it flipped into that downtrend. Why don't I pull back a single market view? We'll just look at the S&P again so you can see exactly what I'm talking about. Okay, so we're going to go back to 2008, 2009. All right, so here's the crash, right? You could see when the market flipped to downtrend caution, to downtrend caution. It's going. The actual signal would have come in. Let's go back a little bit more. Let's go to 2007 through 2009. Okay. So you would have flipped August 2007 into September. That's when the downtrend started. And if you had stayed with that downtrend through that whole time, you would have caught that bottom. If you had just gotten out, you would have avoided all of that blood and you would have gotten back in July 2009. What happened in July 2009? Mega rally, right? So you have the availability to look at this and make some pretty valid assumptions here that there are positive periods, but when you look at a longer term view, not just 2 years, it's telling you this market just doesn't make money because downtrends are violent and they swing back up rapidly, right? But you can save a lot of money by sitting out the periods when you're not in an uptrend or uptrend caution state. And that is what I find to be one of the most useful takeaways from here. I mean, you can repeat this. You can go back and look at the Liberation Day thing. That's a time when, frankly, a lot of the trend following funds got killed because that was such a bad whipsaw, the Liberation Day stuff. So, while they might have made money shorting in prior crashes, you would have made money by sitting it out. And that's where the real edge was. So had they just said time to get out of the long and wait versus trying to whipsaw into a very violent downturn, that could have all been avoided, right? So there is merit to combing through each market. When you look at it on a level of the indexes, they're all going to react relatively similarly, right? Where are you going to see big opportunity shorting? There's going to be some stuff in single stock futures. There's also going to be some very interesting ones in the energies, the metals. You remember there was negative oil, right? so there's definitely, going back. If we look at maybe just crude here. Where was the negative? That was, yeah. So there is some, obviously there's some big expectancy. And if we're going to go, let's just look at what that would have been in terms of contracts here. Let's go 2020 to 21. Here's the negative oil, right? So you would have made more money shorting oil in 2020, 21 versus the upside. Again, the longer view you go out. Now this is interesting because unlike S&P, where all the downtrend trend regimes tend to show a negative response, oil is showing that it's very damn tradable in uptrend and downtrend. So again, this is the kind of information you can spend hours gleaning, information about what markets are actually structurally and volatility wise meritable to short, and which are meritable to say, what, it's looking like there's going to be some crash or some correction. I have my signals that told me it's in a downtrend. I'm getting out of my longs and sitting and waiting, right? That's two ways to deal with the same thing, because you've looked at the results and see which markets show positive expectancy during downtrends and which show chop and destruction. And it's really quite eye-opening. And it really shows the, unique character of different sectors and different markets, right? We're supposed to be in trend. We're supposed to be agnostic to everything. Markets that are open for half day, markets that are thinner, markets that are a lot more driven by, global news cycles like oil, there's just going to be a lot more opportunity, long and short. So have a look around.